was the Finance Club event that's coming up. It'd be great if you guys joined or invited your friends. I invited all my friends. My friends from AXA, Wells Fargo, Green Spark, Capital Grain, Pillar 6, Merrill Lynch, and they got some other people from Silicon Valley Bank and Salesforce and stuff. Is this 123 or 136 or what's your? 123. 123? Okay. Do you think Salesforce or Merrill Lynch or Wells Fargo hires people in digital media, in marketing, in operations, in data analytics, in accounting, in finance? Yeah, okay, exactly. So there's great opportunities on the financial services side. This is the exam we're going to have tonight. Kevin didn't tell you I was going to give you a pop quiz? No, you didn't tell me. You guys don't know me, do you? I'm pretty fun. Yeah, we're going to work through some problems. How far did you guys get in your book? Have you guys done discounted cash flows, future values, present values? Okay. Have you done bond valuation or stock valuation? You have? Oh, cool. Have you done capital budgeting, discounted cash flows, net present values? Present values, internal rates of returns, break-evens, all that fun stuff?
Yeah, did we just finish chapter 6?
You did it? Was that the capital budgeting piece?
Risk and return.
Okay, so that's mostly what, standard deviations and variances and that kind of stuff? Has anybody ever bought a multi-billion-dollar company? You ever bought a tech company, startup company? You ever bought $1 million worth of real estate?
No.
No? Really? Pretty cool. Did you guys get these? No? So the first thing I'm going to ask you to do is go on to Yahoo Finance. Go to Yahoo Finance. Go to Yahoo, click on Yahoo Finance. Do you guys track the market? Are you guys trading yet? Do you guys trade? Are you trading stocks, bonds, oil, gold, foreign currency? No? So go up to Yahoo Finance. Where did the Dow settle today?
It's looking like 26, 8, 28.39.
Yeah, is it up or down for the day?
Up 0.2%.
So, and how many points is that?
54.
54
45.
points? Okay, usually when the Dow Jones, it's volatile and it settles, if it's either up or down by 100 points, it's just noise. Okay, if it's up or down 250 points, there's some kind of news event that occurred. If it's up or down 500 points, then something major happens, and if it's down 500 points, I'd probably be a little scared. And if it crashes 1,000 points, they're going to shut down the exchange, and I'd be freaking out. Because it's either some kind of Middle East or some kind of nuclear threat or some kind of massive market failure from one of the large institutions or something happens. Is this stuff interesting or important to track? Yeah, you guys are all going to own stock. You're going to own bonds. You're going to own real estate. That's how you accumulate your wealth. Unless you're super rich already and you're going to inherit a couple hundred, $1 million, then I wouldn't worry about it. But for the rest of us, we're probably going to have to save and accumulate and invest our money and try to get to the $5 million that we need to retire at a fairly good standard of living. So you're going to be exposed to all these markets. And really, a 50-point jump in the Dow really isn't meaningful. Although there was a major rout in the bond market, I think the 10 and the 30-year went up. I don't know, where's the 30-year yield right now on the 10-year Treasury? Where's the yield on the 10-year Treasury? Because somebody said that they were selling off bonds and buying stocks today. So where's the yield on the 10-year Treasury? And it's all right there in Yahoo Finance. Where's the 10-year yield? If bond prices go down, interest rates go up. Excellent. Okay. So if the bond yields went up, then bond prices did what today? If yields went up, then bond prices did what?
Yeah.
They went down. And why would people sell off bonds? where do they put their money? They're selling off the bonds where they usually put the money.
They reinvest it,
And,
more bonds.
no, they usually go into the stock market.
Or housing, right?
Yeah, and why would they go into the stock market over the bond market? It's because the US economy is growing super fast and unemployment rates are at frictional levels. Probably the lowest unemployment rates we've seen in, I don't know, 20-something years. And that means that the unemployment rate's low, then wages are growing fairly rapidly. They're around 3%, which means that could cause inflation, higher inflation expectations, higher bond yields, and lower prices. It's all related to each other. Where is the oil prices today? Actually, Russia came out and said that they felt oil prices were too high. And where's that oil trading per barrel right now? $76. Is that pretty high? I mean, where was it like a year and a half ago? No, it was actually like 35, 40. So oil prices have gone up like 50% within the last, 12 to 14 months. Is that a lot? Yeah, I mean, don't you guys drive your car?
Yeah,
Yeah, isn't it more expensive now? Yeah, exactly. And that's inflationary too, which will push up inflation expectations, push up bond yields, push down bond prices. Okay, where's gold trading today? People are telling me that gold could rally here because of higher wage growth and higher inflation expectations and a GDP growth rate of 4.1, 4.2% and unemployment at like 3.8. So where's that gold trading per ounce? Is it down today? What's it trading at? What is it? Yeah, it's right around 1,200. It's basically been in a trading range for quite some time. However, if you go back over the last 12 months, gold has actually gone up. But if you go back like 2-3 years, gold had a major sell-off after the financial crisis. It's really starting around 2011, 12, 13, and people sold off a lot of their gold and went into stocks. Because stocks were undervalued at that time. Gold was overvalued at that time, so they were sector rotating. And then where's the dollar to the pound and dollar to the euro today? Do we care about currency exchange rates? Are we a global economy? Multinational corporations trading trillions and trillions of dollars of goods and services and capital flowing all across the world instantaneously across high-speed telecommunication networks. And the currency markets are the largest of the capital markets. So where's the dollar to the pound today? What's it trading at? Come on, if you guys are going to be traders, don't you want to be a trader? Trading and be an investment banker and private equity, venture capital, stuff like that. I mean, those guys make a lot of money.
The euro to the dollar.
Yeah, do it the other way around. Do dollar to the euro or dollar to the pound, because there's been a lot going on with Theresa May and her ability to be able to exit Brexit, gracefully. Well, she was dancing to ABBA today on stage. So where's the dollar to the pound? Hello?
I'm not
Hello?
sure.
Anything? No? Disengaged?
Trying to get you
Don't
the
care?
four
What?
decimal places.
Yeah, what do you got?
I have it on, I used to trade currency.
I think dollar to the pound is what, like 1.13? Something like that, 1.14? Is that what it is?
Yeah.
So it cost me $1.14 to buy a euro. Is that correct? Yeah. And what if it went to 1.16? What if the dollar to the euro went to 1.16? Did the dollar appreciate or depreciate? Excellent. What'd you say? Excellent. And then what did the euro do to the dollar? Excellent. That's totally awesome. You totally got it. Okay, that's kind of the game that I play with my classes. We open the class, we start going through trade simulations, we track the markets, because we want to trade the markets at some point in time. You're going to own the markets, so you might as well start tracking them now, because they're going to be in your portfolio. And are you going to be happy when your portfolio value goes down? No. You're going to be happy when it goes up, but what if it goes down? Yeah, you're not going to be happy. Okay, so you got to watch the markets. All right. So what I'm going to do is I'm going to do a quick introduction to securities valuation, or really even company valuation or valuation. Did you go through the 4 intrinsic valuation methodologies? Have you gone through that? Have you ever heard of perpetuity model? Have you heard of the perpetuity model? No? What about the Gordon growth or the constant growth model? Have you been exposed to that? Yes? No? Don't care? No? Don't care?
asking me?
Yeah,
I'm not sure, it doesn't sound familiar. to
okay,
me,
excellent. And then what about the multiple approach? I'm just used to interaction. You know, I've worked in industry for a long time. I ask a lot of questions, we dialogue back and forth, we all learn from each other, and it's really strange when I come into the classroom and there's just that dynamic is not there. You're really gonna have to get used to that dynamic when you go work, because they're gonna expect you to engage in all of the conversations. Even if you don't know it, you're learning, you're giving input, you're solving problems, you're going, you know, and solving problems. Okay? So I truly believe that academics and the way that they teach is not really conducive to smooth transitions in the work world. And you are all business majors too. So I think that academics is, you know, you guys have been conditioned for the last 16 years in an academic environment, and you haven't been subjected to a simulated real-world business environment, which is where you're going to be working. Okay, so that's what I try to simulate within the classroom. What about the discounted cash flow methodology? Have you been exposed to that too, DCF? Yeah, okay. So I'm going to go through the theoretical intrinsic valuation methods, the 4 valuation methods, and then we're going to apply them. Okay? And then if we can get through over the next couple hours to the end, which is the capital budgeting investment decision-making matrix, I think it might even help you in your capital budgeting and your investment decision-making sections of the class. Okay? And these are actual case studies that I wrote up based on my experience in real estate and capital markets and investment management. Okay? Any questions on the expectations? Does everybody have a calculator? Does everybody have a calculator? Anybody want to borrow a calculator? I have like 6 calculators. And then I do need these back. Okay? Do you have any preference? Usually what you do is when you walk into a meeting, you usually get to the meeting like a half hour early. You sit down, you put your notepad down, you got your cup of coffee, you got your calculator, you got your tablet, you got your laptop, you know, you got your pen and pencil, and you're ready to go. You get there early. And you get there an hour early. If you're doing a major presentation, you have to get there an hour early.
Do you mind if I use my phone for a calculator?
Yeah, no, that's totally cool. Okay, last. You're not going to need the calculator for the first part of this, but you will need it for the case studies. Okay, and then I would hope that you would be engaged in this process, because basically when you sit in on a meeting, and hopefully you'll be sitting in on some of the evaluation meetings or the acquisition meetings of other firms, or acquisitions of the real estate, or calculations of the capital structure, or calculations of the intrinsic values of the stock, because you're going to get stock options, I hope, if you go work for a publicly traded company. But you got to be working through the process and doing the calculations, because the individual who's conducting the meeting usually doesn't have a calculator to do the calculations, and they're relying on you to be able to do the calculations and then verify the calculations that they're correct. The worst is to be able to feed erroneous or errors to the person who's doing the calculations, and then find out, oh, excuse me, Tom, we made a mistake on that, you're going to have to go back and redo that again. They'll probably just end the meeting and walk out furious, because you basically took them down a rabbit hole. Okay? All right. So perpetuity model, and you guys can look this stuff up too. Okay? Does anybody know what the perpetuity model is? It's the most simplistic valuation methodology. Okay? And you can do a lot of this stuff in your head, in our back of the envelope, to get to an intrinsic value very quickly. And it could be the intrinsic value of a bond, intrinsic value of the stock, intrinsic value of the company. Basically, the 4 methodologies are standard best practice approaches to valuation. The question is, what are you trying to value? And then the discount rate and the cash flows basically change depending on what you're trying to value. Does anybody know what the perpetuity model is before I put it up there? Yes? No? Yes?
PV equals C over R, or C over 1 plus R to the T.
Yeah, it's close. Yeah. I have a different nomenclature. Everybody has a little different nomenclature. So this is going to be the first model. I use cash flow, T plus 1. And obviously T plus 1 is cash flow 0 multiplied by some growth rate. And I assume everybody by now is comfortable with future value factors and present value factors and all that stuff. Okay. And then what are we going to divide this by? Do we divide it or do we multiply it? I'm testing you.
1 plus the rate to, all to the power of t.
Okay. And then you divide by I. What's I? Could that be the discount rate? Could that be called the discount rate?
Yeah.
Yes. Could it be also the expected return? If I'm buying a stock, can I divide the future cash flow by my expected return to get my intrinsic value? Can I do that?
I believe so.
Yep, I can do that too. So this is going to be the value using the perpetuity model. Can I also use, how else can I calculate an expected return? Is anybody testing you to see if you know? If I wanted to get an expected return on the equity, since I'm buying a stock, what model can I use? This is the model that you need to basically tattoo on your ankle and basically memorize for the rest of your life.
Second step by step.
No. Anybody know? Does anybody know what this is? Anybody know what this is? You can look it up. CAPM? No? Not yet? Capital asset pricing model, better known as CAPM. If you go and do an interview as an analyst anywhere, they're going to, as a financial analyst, they're probably going to ask you what CAPM is. If you don't know, that's the end of the interview. Okay? So you can look it up too. You can go onto the computer and type in CAPM and then tell me what CAPM is. This is your generation has instant access to data and information via the internet, handhelds, tablets, laptops, and computers in front of you. So when people start asking you questions now, they're going to expect you to get on your tablet, phone, laptop, computer to get the information. Seriously. And when you're in these meetings now, you have access to not only the internet, but you have access to the internal intranet, which has all the internal data along with the external data to get the information instantaneously, to give to me as the manager so we can solve the problem right here and then go execute it right when we leave the meeting. It's not like, no more is it, I'll get back to you in 2 days. We can solve it, figure it out right there in 2 hours that otherwise would have taken us 2 days or 2 weeks in the 90s and the early 2000s. Now we can get that information instantaneously, figure out the solution, and go execute. Okay? And if you can do that, it's amazing. So what's CAPM?
Do you want the formula?
Yeah.
Okay, so it's the risk-free rate
Got it,
plus the beta
got it,
plus the expected market return
Got
minus
it.
the risk-free rate.
got it. Boom. So can I calculate, can I use CAPM to get my expected return?
Yeah.
Yeah, got it. Okay. And then is this cash flow in the perpetuity? Is the cash flow forever? Does it grow at a constant rate or does it remain flat forever? Grow at a constant rate or remain flat? Grow at a constant rate. This is where I drive my students crazy because I ask them questions over and over again until I get an answer. And you got basically a 50-50 chance. You got actually, you're going to be totally wrong if you don't say anything. If you say something, you got a 50-50 chance of being right. And if you know it, then you got a 100% chance of being correct. So under the perpetuity model, do you assume that the cash flow remains flat forever or grows at a constant rate?
Should increase.
Okay, anybody else?
Flat.
Remains flat. So it's a constant. Okay, boom, got it, done. Perpetuity model. Pretty simple. What's the cash flow? What could the cash flow be? Can I use EBITDA? If I'm valuing a firm, can I use free cash flow or EBITDA at the firm level as the cash flow? Can I use that? Can I use that? Yeah, I can use that. Can I use EBITDA per share? I divide it by the shares outstanding. Can I get the EBITDA per share? Can I do that? And then value the stock, right, using the free cash flow. I'm going to use EBITDA and free cash flow for startup companies and for companies that have been just launched. Okay. Can I use earnings? Yeah, I can use earnings. All right. Can I use earnings to get the value of the firm? Can I divide it by the shares outstanding and get, what's this? Earnings divided by shares outstanding gives me, got it, EPS. Can I use EPS as the cash flow to get the value of the stock? Can I use earnings per share? Yep. Can I use earnings to get the value of the firm? Yep. Can I get, use EBITDA to get the value of the startup company? Yep. Can I use EBITDA per share to get the value of the shares of the newly IPO'd startup company? Can I do that? Can I use dividends? Can I use dividends or dividends per share to get the valuation? Yeah, I can do that too. So it depends on what you're valuing is going to determine what not only the cash flow is, but also what the discount rate is that you're going to use. Okay? And remember that your CAPM gives you the expected return from the investor standpoint. Okay? If I'm an investor, I'm using CAPM, I'm going to run the calculation, I'm going to come up with my expected return. Or I can be from the firm standpoint. I'm the firm. So this CAPM also becomes the cost of equity. From the firm standpoint, it's the expected return from the investor standpoint. Okay, so CAPM is extremely versatile. And it's the #1 methodology used to get expected returns on the equity and the cost of capital of the equity. Okay? And you're going to use that, obviously, as the cost of the equity when you do the weighted average cost of capital, when you do the capital budgeting to get the discount rate. Am I speaking too fast? Okay. We speak really fast, so if you're confused or if I'm going too fast, you can slow me down and I'll go into some of the nuances. Okay. So that's perpetuity. So let's do Gordon growth next. I mean, Gordon growth is also called constant growth. Or constant. Got it. Okay, do we know what the equation is for that? Gordon growth of the constant growth model? Were you supposed to read the stock chapter? Do you guys read the chapters? Do you guys read the chapters? My students don't read the chapters. Some of them do, not all of them do. Okay, so what are we going to do? What's the equation? Again, you can look it up, you can look at the PowerPoint, you can Google it. What's the numerator going to be? What's the numerator is what? Cash flow? Do we use last year's, this year, or next year's cash flow? Last year, this year, or next year's? Test question. Last year, this year, or next year's cash flow? Last year, this year, or next year?
Last year.
Last year, so I'm looking backwards when I do the valuations. Or am I looking forward? When I do valuation work, do I care about what the value was yesterday, or do I care about what the value is going to be tomorrow? Tomorrow. So am I going to use last year, this year, and next year's cash flow? Next year's. And I'm going to divide it by what? Using Gordon growth. Using constant growth. What do I divide it by? Come on, you can do it. Can you look it up? You got a computer right in front of you. That's why you have you're in a computer lab.
Discount rate
Discount-
minus.
what is it?
Discount rate minus growth rate.
Nice, nice, excellent. So you're going to take the discount rate minus the growth rate. So you assume that the cash flow is going to grow at a constant rate forever. Okay? And that's going to give you the valuation using Gordon growth. Bam. Got it. If I'm trying to value the firm, can I use EBITDA? Next year's EBITDA? Yep. Can I use next year's earnings? Yep. If I'm trying to get the value of the share, can I use EBITDA per share next year? Yep. Can I use earnings per share next year? Yep. Got it. I can use, as the discount rate, I can use the expected return, using CAPM, or I just say, hey, on all of my investments, for all my stock investments, I require at least a 10 or 20% rate of return. So this is either going to be 0.1 or 0.2. Okay? And then you estimate the growth rate, and then it's going to give you the value. Okay? Then the next one is the multiple approach. This is the stuff I burn into my student experience. because they're gonna be owning stocks and bonds, and real estate, and they're gonna be getting stock options, and all, and so they're gonna be constantly having to do valuation work. Okay, so what's the multiple approach? Can you guys help me out? Let's see, we're in a meeting and we're trying to value our stock. And I remember taking Biz Ed 123 at St. Mary's. And in the finance class, they reviewed a multiple approach. I remember that, but I don't remember what that is. Do you? Okay, what's the first variable that I need to for any evaluation?
Cash flow.
I need the cash flow. Last year, this year, or next year? Next year, excellent. So I need the cash flow. And can I use EBITDA? Can I use EBITDA per share? Can I use earnings? Can I use earnings per share? Yeah. Okay. Now what do? Do I divide it by something or multiply it by something? Actually, the name of the valuation method is actually an indicator of what you do. So what would we do? Would I divide it by something or multiply it by something? Multiply it, excellent. And what do I multiply it by? Let me help you. I multiply the cash flow by the, repeat after me. Oh, nice, excellent. So you multiply by the multiple. Okay, am I going to use last year, this year, and next year's multiple? Last year, this year, and next year. Last year, this year, and next year.
Next year?
Next year's. Excellent. T plus 1 equals the value using multiple. Got it. Okay. I work for a private equity firm, investment bank, venture capital firm. We're looking to buy a company. We're trying to figure out the value of the company. There was 3 transactions that were conducted last year. Okay. We did 2 of them, and then another, Kleiner Perkins did the other one. So we know with the value, or the price in which the firm was sold at. And we also know the EBITDA. Can I calculate a firm level multiple using the value divided by the EBITDA to get the multiple? Can I do that? Can I do that? Say it. Yes, you can. Can I use the value divided by the earnings to get a multiple for an established company? Yep. Can I use the share price divided by the EBITDA per share to get a multiple? Can I use the value, the share price divided by the earnings per share to get the, what's that called? Can I do the share price divided by the EPS? What's that ratio? What's that called? What's that called? Price, earnings, multiple. Did you guys do financial ratio analysis yet in this class? Financial ratio analysis? No? Yeah? I got yes and I got no. A little bit? Okay. This is also called price earnings or the PE multiple. So if I don't know what the multiple is, PE multiple is for my firm, can I go find other firms like mine that have the same age and the same industry and the same style and use those multiples to multiply against my projected earnings per share or my EBITDA per share to get the value of my firm?
Wasn't that what it's for?
Yeah, totally. The multiple is what you use to basically go out into the marketplace. We already know what the cash flow is next year for our firm. We don't know what the multiple is. So we go out and we find peer group and other firms and get their multiple and apply it to our cash flow to get our valuation, either at the share level or at the firm level. Okay. Can I also do this? 1 divided by I. So can I take 1 and divide it by the expected return to get a multiple? Can I do that? Can I do that? Yes. Yeah, I can do that. And actually, when you take this cash flow and multiply it by this multiple, you're going to get the same value as the perpetuity model. So can also manufacture multiples when I don't have multiples or transactions. And I can I do this? 1 divided by I minus G. Can I create a multiple like this? Doing this? Yeah. And if you take the cash flow multiplied by this multiple, it's going to give you the Gordon growth valuation. But the problem is that investment banking and other, high-level valuation firms, they're not using these. They're using these because this is the number one method. The number one method that they use when they're doing high-tech firms. Okay. And what's the next valuation method? You guys heard of DCF? Discounted cash flow? Kevin's been grinding you through the discounted cash flows, right? Discounting cash flows back to the present, to get the present value. Present value, DCF equals, what do? Let's use a 3-year holding period as an assumption. Got it. Okay, so what do? What's the model structure? You have to burn this into your brain. You need to memorize this stuff. And you can't say that I'm a marketing major and I'm never going to use this stuff because I was a finance major and then went into marketing. And they were asking me stuff. To do return on advertising campaigns and marketing campaigns, and if I would, project out what the cash flows will be in the early and late majority adoption phase of the division or the product line, and do the discounted cash flow back to the present to get the present value to see if we should invest in that new product line. So we do that too. Okay. So what's the model structure?
Use the free cash flow.
Okay, we can do that. So I'm going to do the cash flow, and am I going to use last year's, this year's, or next year's cash flow for year 1? Do I use last year's, this year's, or next year's for year 1?
So,
I think somebody said it. Last year's, this year's, or next year's? Last year's, this year's, or next year's for the first year? Last year's, this year's, or next year's? Last year's, this year's, or next year's? Next year's. Next year's. Okay. So CFOT plus 1 equals CFOT equals 0 times 1 plus G. So you don't use last year's or this year's, you use next year's. But you need last year's or this year's to get next year's. Okay, but you use next year's. And then what do I divide that by? What do I divide it by? What's the model called? Discounted cash flow. Okay, so then what do I discount this by?
1 plus the discount.
You got it. 1 plus this. 1 plus G to the what? To the what? Excellent. Okay, and then what do we do now?
The same thing, but square.
Got it. Okay, so then I'm going to do this. 1 plus G squared. How do I get cash flow 2? In year 2. What do I do? What do I have to do to this?
So T plus 2.
What?
T plus 2.
Got it right there? Yeah, I can just go like this, CFOT plus 2, that would be easy. But usually in the real world, I'm doing something to this cash flow to get to this cash flow. Because usually do the cash flows remain flat? When I buy a piece of real estate or a company or a stock, do the cash flows remain flat forever? No, what do? They usually grow. So how do I grow this to get this? How do I grow it? What's the formula? I'm testing you. Would I use a present value factor or a future value factor? Present or future value factor? Future, excellent. So what would I multiply the cash flow T plus 1 by to get cash flow T plus 2? How do I grow it? I'm testing you. Let's see where you guys are. If you know this stuff. You gotta know this stuff. Can I do this? CFO T plus 1 divided by 1 plus G. Can I do that to get this? Is that growing it out? When I do CFO T plus 1 divided by 1 plus G, am I growing it? Am I growing it? No, I'm not. What about if I multiply CFO T plus 1 by 1 plus G? Got it. Okay. So how do I get CFO T plus 3? What do we have to do? What do we have to do to get CFO T plus 3? Got it. 1 plus G. Got it. Boom. And then what's the discount factor? Got it. Plus G to the third. Okay, got it. So can I discount these cash flows? If this is the firm that I'm trying to value or the stock, can I just discount these back to the present and get the value of the firm? Yes or no? Test question. If I'm valuing a firm or a stock, and the holding period is 3 years, can I discount these cash flows back to get the present value, and that's the value of the company? Yes or no? Test question. Okay,
I don't
you got,
see why not.
am I going to be able to sell the company at the end of the 3rd year? If I have a company, can I sell it?
Yeah, you can sell a company.
Excellent. And then if I was going to get the value of the company, wouldn't I need to know how much I can sell it for at the end of the 3rd year?
Yeah.
Yeah, exactly. So what I usually do is I go like that, okay? And then what we need to calculate is the terminal value, okay? The terminal value. You need to take notes or wake up or do something, because this is the most important procedure in the present value discounted cash flow procedure, okay? All right, so how do I calculate the terminal value? What do I need to do? Test question, does anybody know? How do we get the terminal value? What am I gonna sell the company for? Any guess? What do I need to get a value? What do I need to calculate a value?
All the components.
Yeah, which the one component is, and one of the components are, to get the value of the firm, I need the, come on, you can do it. I need something. How do we calculate the value using the other 3 methods?
Free cash flow.
We need the cash flow. Got it. And then do I use the 3rd year, or do I grow it out to the 4th year? 3rd year or 4th year? 4th year. Excellent. Nice job. So 4th year. So I need cash flow T plus 4. How do I get cash flow T plus 4?
Why do you use it for?
Because you're assuming that you're selling it at the end of the 3rd year. Okay. So how do I get cash flow T plus 4? What do I need to do? Nice job. Okay. 1 plus, oops. This is the most important thing right here. Is 1 plus G. Got it. It's going to give me cash flow T plus 4. Got it. So now, how do I get the value? How can I come up with the value? Using the 4th year cash flow.
Divide it.
Excellent. Divided by what? You really have 2 options.
The discount rate and the expected rate.
I'll take the first one, the discount rate, okay? So I'm gonna discount it by the discount rate or the expected return or whatever it is, okay? Now, what do I assume? I use the perpetuity model to get the terminal value. What do I assume about the cash flows into the future forever? What do I assume? Are they gonna grow at a constant rate, or are they gonna remain flat? Test question. I use the perpetuity model, am I assuming that cash flows are gonna grow at a constant rate or remain flat forever?
Remain flat,
Say it, yell it at them.
will remain flat.
It'll remain flat, okay? What if I think, this is a startup company, tech company. So do you think that the cash flows are gonna remain flat forever, or do you think they're gonna grow at a constant rate? Grow at a constant rate. So what model do I use?
Multiple production.
Gordon Brown. Nice. I can use the multiple to do this too, okay, if I want to. Boom, got it. That's gonna be my terminal value. Now what do I do with the terminal value? What do I do with the terminal value? Do I just add it to the discounted cash flows to get the present value, and that's the value of the firm? What do I do with the terminal value? What would you do with that? Do I divide it by 1 plus g to the third? Do I divide it by 1 plus g to the fourth? What do I do? Guess. It's better to guess and be wrong than to not say anything. Because when you're not saying anything, you're waiting for me to give you the answer instead of you trying to figure it out. That's how you learn, is through trial and error, through frustration. Okay? And it might just come to you and you're right. So what do I do? Divide it by 1 plus g to the third, or 1 plus g to the fourth?
1 plus 2 to the 4th.
Okay, I got 1 plus g to the fourth. Anybody else?
Third.
Third, anybody else? Fourth, I got 2 fours and 2 threes. Anybody else? Tiebreaker?
Three.
Three, got it, 3. You want to divide it by 1 plus g to the third. But what I do is I take the terminal value and I basically add it to the third year cash flow. I add it to the third year cash flow. Bam. And then I get the discounted cash flow for year 3, I get DCF. For year 2, I get DCF. For year 1, I basically add them up to get the present value of the firm or present value of the share. That's the most important procedure. Now, DCF methodology can be used for established companies. They don't really work very well with startup companies. Okay, we usually use multiple approach for startup companies, but for established companies, if we're going to value the company and/or the share, we would use the discounted cash flow method. These are the two main methodologies. These are just very simple methodologies, but as you can see, both of these can be included in the discounted cash flow methodology for the determination of the terminal value. Okay. So that's basically, do you want to take a picture of that before I erase it? Okay. And then we can do, maybe do a couple problems, some real life problems where we actually apply this stuff. Okay. And then depending on the time, I don't know how many problems, but I would like to present to you the investment decision making matrix. I'm not going to see it in any class because I developed it myself. Okay. 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 Got it. You done? Okay. And I'll make, if you email me, I will send you the video. I videotape all of my lectures. I probably shouldn't videotape my lectures, but I do. And my students seem to appreciate it. Because I talk really fast and this stuff is pretty complicated, and you usually need to go back and review the materials to be able to really understand it. I mean, it took me years to be able to figure all this stuff out. I mean, it took me years to figure it out. And this lecture that I just gave you basically took me years to do. I know it's not beautiful, but and you're going to be presenting in front of the board, you're going to be presenting in front of senior level managers, and you're going to be presenting in front of people in the future. Okay? And you're going to have to do this, guys. Either in PowerPoint, which I don't recommend. You want to draw this stuff on the board because it's more compelling, and it basically shows your competency. So usually your ability to jump up in a meeting and schematic stuff out on the board will get you major bonus points. Okay? So what's the first problem? What are we valuing? Okay, so we're a venture capital private equity firm. Oh, we're going to buy a technology company. As we know, there are 4 main valuation methodologies. For this case study, we are going to use earnings before interest, taxes, depreciation, and amortization, EBITDA for the target company. The following are the case study assumptions. And I'm going to ask you about the case study assumptions. This is what my students do in my class. And this is only like half the exam. Okay? And we spend about a month on this stuff. And then they come in and they take the exam. We go over the solutions, and then I give them the exam, and then they do the best they can. Okay? And then if they don't do a good job, or they do a really good job, if they do a great job, they move on. If they don't do a good job, they gotta go back and redo it, okay, until they learn it. Okay? So, you're gonna use the perpetuity model, either for the initial value or the terminal value, the Gordon growth for the initial and terminal value. The multiple approach, they actually even provide you with some multiples, okay? And the discounted cash flow. The assumption is we are gonna acquire a small tech startup company in the software consumer product space. And actually, this is a global company, okay, in Cupertino, being bought by a private equity firm or a venture capital firm. Also show the calculations for the valuations utilizing the above methods, blah, blah, blah. Then they give you the assumptions here. And then it asks you, using perpetuity, Gordon growth, multiple approach, what is the intrinsic value of the target company? Using discounted cash flow, what's the present value, net present value? I'm not gonna make you calculate the internal rate of return, but you should be able to determine the break even if there is any break even on this thing, okay? Would you accept or reject the project? If the net present value was negative, what 4 iterations would you go through if you still could not get the project net present value positive? What would be your last scenario? And what would be the net present value need to be? Okay? So just on one page, basically is your whole book, almost your whole book. Okay, so let's do the valuation. So what valuation methodology are we going to use first? What valuation methodology are we going to use first? Very simple one.
Discounted cash flow.
No, that's the hard one.
Perpetuity.
Yeah, we'll use the perpetuity first. Okay. Got it. All right. And then what do we need to do to get the evaluation using the perpetuity model? What do we need?
Need cash flow.
We need cash flow. This year, last year, this year, or next year?
Next year.
Next year's. Does it give us next year's, or do we have to calculate it? Does it give you next year's, or do we have to calculate it? Yeah, we gotta calculate it. So what's this year's cash flow? 20 million, got it. Okay, and then where does it tell you? Is there any growth rate scenarios? Pro forma cash flow growth rates. What's the pro forma cash flow growth rate in the first year? How much?
40.
That's the going in growth rate.
40.
40%, excellent. So what would I multiply 20 million by?
0.4.
So I would multiply by 0.4. Is that right? Is that correct? Is that how you grow stuff?
No, 1 plus.
Got it. So 1.4. Got it. Okay. So what's 20 million times 1.4? Okay, that's why I gave you the calculators. So I would practice your calculator calculations and not just let us do all the
It's
problems
28.
by yourself. What is it?
28.
Thank you. Can somebody verify that for me? Know what you got?
Yeah.
Thank you. Got it. And then what do we do with the 28 million? Well, gotta get engaged. You're gonna be engaged when you go to work. Because they're gonna be paying. What? Yeah, so what is our discount rate that we're gonna use? What do we use? Does it tell you? Do I tell you what the discount rate is?
No.
Does it?
I don't think
Oh, no, it has to be.
Expected rate of return, ERR 30%,
Got it.
ERI terminal
Got it.
40%.
So 30%, so it's 28 million divided by 0.3. I'm gonna want my calculators back if you're not gonna use them. And I'm sorry, I didn't eat all day and I get a little sarcastic at this time of night after being, up since 5:30 in the morning. So don't take it personal. I'm actually a really nice person. So what's 28 million divided by 0.3?
93 million?
What is it?
93?
93?
It's 3.
Yeah, just round it.
Yeah.
Is that correct?
Yeah.
Yeah, thank you. Okay, so we got that one. What's the next method? Gordon growth, excellent, thank you. Okay, and then how do I get the valuation using Gordon Grove? What do I need? I need the cash flow last year, this year, next year's. Next year's, what's next year's cash flow? 28 million, excellent. Got it. And then what do I divide it by? What do I divide it by? Discount rate, what's the discount rate? 0.3. And then what am I gonna use to, does it give me a growth rate, free cash flow growth rate? Going in, 15%, 0.15. So what's the product? 0.3 minus 0.15. 0.15. It's 28 million divided by 0.15.
186.67.
186. Just round up. 187.
Yeah.
187. So 187 million. Got it. Okay, what's the next methodology? What's the next method?
Multiples
Multiple
approach.
approach. Got it. What do I need to calculate the multiple approach? I need cash flow, last year, this year, next year's. Next year's, what's next year's cash flow? 28 million. Got it. And then what do I multiply that by? Do I multiply it by the discount rate? Or the multiple, nice. And then do they give us multiples?
Yeah.
Yeah, okay, so what are the multiple ranges? So I usually do 55 times first, and 44 times, and then 22 times. Got it. So that's gonna give me a range of valuations. So what's 55 times 28 million? It's 55 times 28 million. You gotta use the calculator. It's practice, right? Unless you can do this stuff in your head, you gotta use a calculator. Okay. So 55 times 28,
1540.
1540.
A lot of zeros.
Yeah, so it's basically 1.54 billion. Do these tech companies sell for billions? Okay. So what's 28 times 44? What is it? One, what is it?
1.232 billion.
1.32?
232.
232 million for basically 1.2 billion. Got it. And then what's 28 times 22?
616 million.
616?
Yep.
Got it. Nice. And, okay. So what are we gonna use? The best case scenario, I won't even call it a worst case scenario, or just some scenario in between. If you're presenting to the board of directors or the investment committee, are you gonna use the high one, the low one, or the one in between? You're probably gonna use the one in between. Okay, got it. Okay, and that, this one, okay, we need one more. What's the next one? Discounted cash. Got it. And we need to get the present value using DCF. Do we know what the holding period is?
3 years.
Is it 3 years? 1, 2, 3. Do we need just 3 cash flows or do we need 4? 4. Got it. And what do we need the fourth one for? Terminal value. Got it. And then what's the discount rate we're going to use? What are we going to use?
30%.
30. 1.3 to the 1, 1.3 to 2, 1.3 to 3. 1.3 to the 1 is 1.3. What's 1.3 squared? 1.7?
Yep.
And then what's 1.3 cubed?
2.1.
2.2?
2.2.
Got it. Bam. So we got our discount factors. Okay, and we're gonna be able to calculate these. Got it. So what's this? What cash flow do we use there? Last year, this year, or next year's? Next year's, okay. So what's next year's cash flow? $1 million. Got it. Now, how do we get year two? How do I get year two cash flow?
You multiply it by 1 plus G.
Yeah, so I'm gonna multiply by some growth rate. Does it give me a 2-year cash flow
Says-
growth rate?
It says 28%.
28%. 1.28, got it. So what's 28 million times 1.28?
85,840,000,
Yeah, yeah, just round up.
so 86 million.
Thank you. Got it. Now, how do I get year three?
36 times 1 plus 2.3, 2.25.
Got it. Nice job. 1.25. Awesome. So what's 36 million times 1.25?
45.
45. Bam. 45 million. And then how do I get, what year do we get? Is this? Year 4. And how do I get year 4 cash flow?
Multiply that by 1 plus G.
Yeah. So which one are we gonna use? What growth rate?
15%.
15. Got it. So what's 45 million times 1.15?
51, 52.
52 million. Awesome. Got it. Now, you as the analysts, okay, it's a test question, you as the analysts. What kind of company is this? It's a tech company, okay. So are we gonna assume that the cash flows are gonna remain flat forever or grow at a constant rate? Yeah, grow at a constant rate. So what model are we gonna use? Gordon Grow, excellent, okay. And then does it tell us here, does it give us a terminal discount rate or a terminal expected
It
return?
does. The terminal expected return is 40 and
40%.
the growth rate is 10.
48 minus 0.1, and that product is gonna give us what, 0.3? Is that right? Because it gave us a terminal growth rate, 0.1 or 10%, and we have a terminal discount rate of 40. Okay. Test question. Why would we use a higher discount rate for the terminal as opposed to the going in? What would be the logic? Why would I use a higher discount rate and a
To
lower?
make sure the investor goes all the way through with the investment.
What do discount
Or that you
rates-
have the money for the longest amount of time until the investment ends up being
Now, let me try something.
fruition.
Let me try something. Can I forecast with 100% certainty what the cash flows are gonna be or what the firm's gonna be in 10 or 30 years from now? No. So would increasing the discount rate be a reflection of the increasing risk, the uncertainty in the future? I can't predict with certainty. And it's a tech company, right? Are tech companies in highly competitive environments? Does technology change very rapidly? Yeah, so I need to reflect that additional risk in the future. So I'm gonna increase the discount rate by 1,000 basis points. Okay? And then in the future, because of the highly competitive nature of this space, do you think that the growth rates are gonna continue to grow at 40 and 28, 25%? No. So I'm gonna take down the constant growth rate too. Okay? So what's 52 million divided by 0.3? And that's gonna give us our terminal value.
173.
It's gonna give us 173 million. Is that right? Yes, sir.
I just had a question. What were you talking about with the growth rate? How it has to change for the terminal value?
Yeah, why I brought down the growth rate
Yeah.
for the terminal growth rate in the future? Because I didn't think, I felt that we could grow the growth rates in the first 3 years after buying this company, because we're gonna bring in our own people and our own systems, and we know how to grow cash flows.
Yeah.
So I can use higher growth rates, but I don't think, and also I used a 15% growth rate for the Gordon growth. But I didn't think that the cash flows could grow at 15% or 40 or 28 or 25 forever because of the highly competitive nature and the rapidly changing technology. So I had to bring down the growth rate to be more conservative and more realistic.
Do you just do that based on what you think, or?
Yeah, based on our experience.
Okay.
Because we've underwritten maybe, I don't know, 50 of these deals. And we underwrite a lot of them. We don't acquire a lot of them, but we underwrite a lot of them. And just by going through that process of underwriting, that's basically what we're doing. When you go through the process of underwriting, you become very instinctual, and you have a lot of data points that you can draw on and experiences and experts around you to be able to give you these kind of simplistic assumptions. Okay? Got it. So we got the terminal value. What do we do with the terminal value?
Add it to your trade.
Okay, so what's 173 plus 145? So we're going to add it, add these together.
218.
218. Got it. Can I get verification for that?
Correct.
Perfect. And what's 218 divided by 2.2? 218 divided by the discount factor.
99.
What is it?
99.
99? Can I get verification on that?
Correct.
Got it. What's 36 divided by 1.7? 36 divided by 1.7? 31?
21.
What is it?
21.
21. Got it. And what's 28 million divided by 1.3?
22.
22. Can I get verification?
Yep.
Got it. And what's 22 plus 21 plus 99?
143.
143. Got it. Is that correct? 142. 142. Yes, sir. Can you?
Back up a little
Yeah.
bit, I got lost a little bit after
Yeah.
you added the 218 million and you divided by 2.2 and you got 99 million.
Yeah. So I grew out the 45
Uh-huh.
to get the 52.
Mhm.
Then I took the terminal discount rate minus the terminal growth rate to get the 0.3.
Mhm.
With the 52 divided by 0.3, I got the terminal value of 173.
Mhm.
I took the terminal value 173 and added it to the 45, and then I got the 218. Then I took the 218 and divided by the 2.2 to get the 99. And then I just did this.
So you got the 99 and then the 36 mil, you divided it by 1.7 to get that 21.
Where's, yeah, the 36 divided by 1.7 gives me 21.
Got it.
And then the 28 divided by 1.3 gives me the 22.
Got
So these are the discount factors. Okay. Got it. That'll work. Got it. So I got 142. Right? Does everybody verify that? Is that correct? So I got 142. I got 1.2 billion. I got 187 million. And I got 93 million. Okay. What's going on here? I got 93, 187. 187 is close to 142. But then I got this 1.2 billion. What's going on? Can you guess what's going on? This is a gazelle. Anybody heard of gazelles? Not gazelles, unicorns. Anybody heard of unicorns? Where these companies are paying billions of dollars for these startup companies. So the simplistic models don't work, okay? These models don't work, right? What we care about is what everybody's paying for cash flows, right? So they're willing to pay 55 to 44 on next year's cash flow. But these companies' cash flows, you marketing majors, you guys love this stuff. Right? innovator stage, losing all that money, burning through cash, maybe even going zombie. And then all of a sudden, through your marketing efforts, bam, your product gets adopted and you get into the hockey stick. Actually, your cash flows can actually go vertical. Just go through the frickin' roof. So this is your early majority phase. And then you're gonna reach some kind of majority phase, and then you're gonna get into late majority, and then you're gonna get into laggard. Okay? The companies like mine are gonna wanna buy companies like this. We're gonna wanna constantly buy companies, so we have an upward sloping valuation of company. And the company, the tech startup company, they gotta do this too. So maybe they come out with their first product, then the second product, and the third product. And then you're gonna be able to maximize the value of the firm. CFO T plus N I minus G equals the value of the firm. I can max out this G, this growth rate in the cash flows by introducing new technologies or new products consistently over time. I'm going to create a revenue path. I'm going to maximize the growth rate in the cash flows in the future and maximize the value of the firm and the shareholder value. The shares in the company. So this is too simplistic, okay? This is too simplistic. And this is what they're paying, the market's paying right now. So this model is the most appropriate, okay? So we're valuing the firm by using the multiple approach because the other ones are too simplistic and they're not realistic. At 1.2 billion. So what's the selling price? How much can we buy this for? What's the selling price? It tells you. What's the owner of the company willing to sell this to us for?
200 million.
How much?
200
200
million.
million. So I got 200 million is what they can sell it to me for, and we're valuing it at 1.2 billion. So let me see. So we're getting 1,232 million minus the 200 million that I can buy it for. So what's my net present value? My net present value. 1,032 million plus. I'm getting a positive net present value of over $1 billion. Would you accept or reject this project? Accept it. And with a net present value that's that positive, is my internal rate of return greater than my 30% expected return? Test question. I'm getting a net present value that's significantly positive. Is my internal rate of return greater than my expected return? Yes. So we're just our expected return is 30%. I bet if I ran the IRR on this thing, if I ran the IRR, it would probably be 1,000, maybe 600%, 300%, something just crazy, right? So when I accept it, if the IRR is greater than the expected return, would I accept the project? Yeah, exactly. And then the break even doesn't work on this thing. It doesn't, because if I can buy it for 200 million minus the 28, minus the 36, minus the 45, I'm getting close, right? But I'm not going to reach using break even, the amount I bought it for minus the cash flows. I still get a greater than 3-year break even. In the tech industry, we want break even in less than a year. We'll take 3 years if it's worth it, but we usually, when we buy stuff, we want to break even in like 12 to 24 months max. Okay. All right, so the break even doesn't work on that one. Got it. So the next question is, that pretty much answers all those. Then the next question asks you something. Let's say you did the mathematics, right? So you did the math. Let's just do a hypothetical here. Our net present value turned out to be negative $1 billion. Negative. Would we accept or reject it? We would reject it. So in the first iteration, we would reject. Got it. Okay. But I talked to the board of directors, I talked to the investment committee, I talked to senior management, I talked to shareholders and other investors, and they said, no, we have to do this project. That company, that product, the company, the IP, the intellectual property, the patents, you know, the potential, their current customers and future we have to buy this company. So, but your model basically tells us to reject it, but we really want it. Okay. So now we got to go to iteration 2. Okay, we got to go to the second iteration. So what's the first thing we can do? We're getting a negative net present value, but everybody says we got to buy this company. What's the first thing we can do?
Cut costs.
Oh, that's really close. Not cut costs, but cut what? Get a price reduction, right? Get a price reduction. So the first thing I can do is go back and renegotiate the deal with the seller. And what would be the price reduction that I would ask for? So I go back and negotiate. So if my negative net present value is a little over $1 billion, I got to go back to the seller and ask for what amount of price reduction to get this thing to work.
Whatever the whole reduction is.
Whatever the negative net present value is. Okay, so I get a price reduction in the amount of the negative net present value. Bam. Okay. And if I can get it, what happens to my net present value? What does my net present value equal? 0. And if the net present value is 0, do I accept or reject it? Test question. Would I accept or reject it?
You accept it.
You accept it. Got it. Bam. Awesome. Okay. Bad news. Do you think sellers will always give you the price reduction in the amount of the negative? No, they're not going to do that. Okay, so you got to go to iteration 3. Iteration number 3. So now what do we do as the underwriting team? Now what do we do? Now what do we do? You're heading up the evaluation unit for this one project. I've done this before when we were trying to sell off my division at Schwab. So what do we do? What would you do if you're acquiring this firm and the board says no, we want the firm, no, sorry board, we couldn't get the price reduction in the amount of the negative net present value. The board and the senior management is going to tell you to go do what? What are they going to tell you to do? Are you going to, first of all, are you going to tell them no? No, you're not going to tell them no. So what are you going to do? What do you do now? This is real life scenario here. What do you do? They're going to ask you this stuff. They're going to be asking you questions, and you're going to have to give them answers because you got a Bachelor of Science degree from St. Mary's with a 3.6 GPA. What do you do? Come on, we already went over it. How long did it take for us to just get this far? What did we just go over in the last hour? What did we go over? What did we do over the last hour? What did we do? We went over valuation, so what do we probably have to go back and do? We got to go back and reevaluate, okay? So what are we going to go back and, what do we got to go look at? What are the components of the valuation process that we got to go back and reevaluate?
The rates.
Yeah, we got to go back and look at the rates. So what rates do we look at? Yeah, we got to look at the discount rates. We got to look at the expected returns. Right? So are we using too high of an expected return or discount rate, or too low of a discount rate if we're getting a negative net present value? Or, say it, too high. Okay, so it's too high. So we may need to lower our expected returns. Okay. not only the going in, but your terminal. If I'm using too high of a discount rate for the terminal value, too high, is my terminal value too low? If I'm using too high of a discount rate, is the terminal value low? If I'm using too high of a discount rate, is the terminal value low? Yes. Is the present value low? Yes. And is the net present value going to be negative? Yeah. Okay. So the growth rates are going to increase the present value and the net present value. The discount rates, okay, if they go up, they're going to lower the present value. Up, down, up. Okay, is the logic. Got it. What other growth rates? These are the discount rates. Again, your answers are right here on the page. Yeah, you gotta go back and look at the growth rates. So we're gonna go back and we're gonna do the going in. We're gonna look at the terminal. What other growth rates do we have to go back and reassess? Were we too high or too low on these? Too high or too low on the growth rates?
Low.
Too what?
Low.
Too low. Exactly, we're too low. And what other growth rates do we need to have? Yeah, the cash flows. So were we too high or too low here? Were we too high or too low? We were too low, exactly. So we gotta go back and look at the pro forma cash flows. Cash flow growth rates. Got it. Okay, what else? Is there anything else that we need to look at? Oh, I got a good one. You may not have thought about. Do you think that the starting initial cash flow would have an effect on the valuations? Yeah, so did we over or underestimate this? We underestimated it. Okay, so you gotta go back and we gotta look at the initial cash flows. Okay? So we're gonna go back and we're gonna re-underwrite it. Okay? And then usually the underwriting process could take a month, 60 days, 90 days, to do the underwriting on these things. So that by the time we get the valuation done, could there be more information that has come in that could change this scenario? Yeah. Okay. I'm sorry to tell you. You went back, you reevaluated, you re-underwrote it, and we still get a negative net present value. And the board's frustrated by that time. Okay. So you got one more final iteration, one more final option. Iteration number 4. I'm going to throw this out just to. Can anybody guess what the 4th iteration is?
You go to the company with that last underwrite you did and reshoot them that value, that with the difference value, and see if they accept that offer?
No. Actually, the 4th iteration is almost impossible to. It's almost impossible to know. You would never know it. In your book, do you, are you guys going to be studying option contracts?
Oh, like buying about pieces.
Yeah, like puts and calls and stuff like that? Puts and put options and call options? Yeah. So the 4th iteration is what it's called. It's just like the call option that you're going to study in your class, but it's called a real call option. Okay, it's like another, I think they mention it in your books, but they really don't talk much about it. And this is more theoretical approach, but it is starting to be used more and more in these types of scenarios in real estate development and biotech and other, highly volatile type of industries and projects. So what you need to do is you need to calculate the value of the real call option. Have you been exposed to call options at all? Yet? So you have this is your exercise price, and then you're going to pay some premium, right, for the call option, right? And then the price is going to go up, and you get the value here, and you're in the money. This is your break-even point. Right here, after you get paid back for the premium that you paid for the call option. And then the price minus the cost is going to give you your profit on the call option. And in these types of scenarios, when you're doing tech companies and real estate development and biotech products and stuff, the valuations are pretty volatile. Goes something like that. Okay. So the value of that call option is based off of three main variables. I mean, you'll probably learn, or you may learn, you may use a Black-Scholes methodology or a model. You might use what is called the binomial tree. This is the calculus behind calculating the call options. And then the factors that drive the valuations for these real call options. One is, first one is management decision. Does the company have to buy the transaction today, or can they wait? Negotiate, kind of time it a little bit too. So that ability to delay or negotiate the transaction and really manage the timing of the transaction has value in the call option. The other is time. So this asset, you know, we're talking about buying a company. Well, how long do companies usually live? What's the life of a company? 6 months? 6 years? IBM, 60 years? Right, so they're a long time. So because you're buying an asset with a long life, there's a lot of time value embedded in the real call option. Okay. And the last one is, and I'm sure there's other ones, but these are the main factors. Volatility. Are startup company valuations highly volatile? Yeah, absolutely. In real estate development and land and biotech, product development, those things are extremely volatile. So the volatility itself creates value for the call option because it increases the probability that you're going to be in the money at some point in time in the future. So that also contributes to the value of the real call option. So if we're, let's say you go and you use these methods, and use simulation, and you collect a lot of data, and use Monte Carlo, and binary trees, Black-Scholes, and use all this sophisticated calculus to come up with the value of the real call option. Value, real call option, got it. Got it. Okay, I'm not going to do this. I'm just going to ask you the question. Get you thinking. What is the value of the real call option need to be able to accept this project? What does the value of the real call option need to be? Yep, you got it. It's got to be the equal to or greater than the negative net present value. Nice job. Negative NPV. Bam. So if the value of the real call option is equal to the negative NPV, what is your net present value equal to? Got it. Do we accept or reject it? Got it. Excellent. You guys are awesome. And what if the negative net present value is greater than the value of the real call option? Then what's the net present value? This is negative, it's greater than the value. So the negative is greater than the positive. It's going to be negative. And am I going to accept or reject it? Reject it. Got it. And if the value of the real call option is greater than the negative net present value, but my net present value is what? Positive. And do I accept or reject it? Got it, yeah. What time is it? What time's the class over? What? Okay, perfect, we're done. You guys are awesome. You did great. Congratulations. Hope I wasn't too much.